Costco sold $275 billion of stuff last year. Rotisserie chickens, gas, mattresses, gold bars, you name it. And after paying for every single item on every single shelf, they kept less than 3 cents of every dollar as profit. So how does a company that thin on margin turn into one of the most profitable retailers on earth? The answer has almost nothing to do with what's in your cart. It's a $30 a year card in your wallet. Costco is a warehouse club, over 900 locations worldwide. No fancy displays, concrete floors, bulk pallets. It looks like the opposite of a premium business. And on paper, it kind of is. That's the trick. In fiscal year 2025, Costco brought in $275.2 billion in total revenue. Sounds massive. But once you subtract the cost of all that inventory, gross profit was $35.3 billion. And after running the stores, paying staff, and everything else, operating profit was just $10.4 billion. Net income landed at $8.1 billion. Do the division, and Costco's net margin is under 3%. Compare that to a typical software company running 20 to 30% margins, and Costco looks like a business that's barely surviving. It isn't. It's structured that way on purpose. Here's the part most people miss. Costco treats its merchandise business almost like a break-even operation. They cap markups on most products at around 15%, far lower than a typical retailer's 25 to 50%. Selling stuff isn't really how they make money. Selling stuff is how they get you in the door and keep you coming back. The actual profit engine is membership. In fiscal year 2025, membership fees brought in $5.3 billion. That number looks small next to $275 billion in total revenue, under 2% of it. But watch what happens when you compare it to profit instead of revenue. Membership fees alone accounted for roughly 2/3 of Costco's entire net income for the year. Read that again. A company can lose money or barely break even selling you groceries and electronics and still make a fortune, because the moment you swipe that card at the door, you've already paid for the privilege of shopping there. Everything you buy afterward just needs to clear a low bar to keep the lights on. This model creates 3 self-reinforcing advantages. First, predictable, recurring cash flow. Membership fees are collected upfront, mostly annually, from a base of over 76 million paid members. That's closer to a subscription business than a grocery store. Costco knows a huge chunk of next year's profit before it sells a single hot dog. Second, brutal pricing discipline. Because margin isn't the point of the merchandise side, Costco can undercut nearly everyone on price. Lower prices drive more foot traffic and more bulk purchasing, which drives supplier volume discounts, which lets Costco lower prices even further. It's a flywheel that gets harder to compete with every year. Third, and this is the psychological piece, once someone pays for a membership, they feel obligated to get their money's worth. That's a powerful behavioral nudge that keeps renewal rates extremely high year after year, which is exactly why membership income keeps compounding.
Let's zoom out on the scoreboard for fiscal 2025. Total revenue, $275.2 billion. Gross profit, $35.3 billion. Operating profit, $10.4 billion. Net income, $8.1 billion. Membership fee revenue, $5.3 billion, roughly 2/3 of net income. Total paid members, over 76 million. Warehouses worldwide, 914. Company-wide comparable sales growth, 7.6%. Every one of these numbers tells the same story from a different angle. A retailer optimized not to maximize what it earns per item, but to maximize the number of people willing to pay for access, and then keep them walking through the door as often as possible. The lesson here goes beyond Costco. It's a blueprint you'll see repeated across totally different industries, from subscription retail to streaming to your local gym. Sell the core product near cost, or even at a loss, and make the real money on the access fee that unlocks it. Once people pay to get in, their spending inside the ecosystem becomes almost a bonus. Costco didn't get lucky into thin margins. They engineered them, because the moment you stopped thinking of them as a retailer and started thinking of them as a membership business that happens to sell groceries, the whole model suddenly makes perfect sense. If you want more breakdowns like this, real numbers, no fluff, subscribe, because next time we're taking apart a company whose entire business model is hiding in plain sight on your grocery receipt. Drop in the comments which company you want broken down next.